Welcome to Akesha's Foreign Exchange Made Easy class. Last day I have discussed Loro account, causes of fall in INR, interest rate parity and relative purchasing power parity. Today I will discuss currency risks, introduction of derivative and underlying asset. Now come currency risks. Currency risk is commonly referred to exchange rate risks, arises from the fluctuation of the price of one currency in relation with other currency for which the investors or companies who have business operation with foreign dealer are exposed to currency risks that may create unpredictable gains or losses. At the firm level, currency risk is called exposure. Exposure is traditionally divided in three areas, namely transaction exposure, translation exposure, and economy exposure. Transaction exposure at the time of international trade, the transaction exposure arises due to business transaction taking place in foreign currency. It is a company's risk owing to the fluctuation in the foreign exchange rate between two currencies in the cross-border trade, such as purchase or sale of goods and services. The risk arises due to time difference between signing date of the contract and settlement date of the deal. Transaction exposure refers to the currency risk transaction denominated in foreign currency. For example, export or imports. When an exporter signs an agreement to export goods and services with the importer of another country, there are numerous jobs to be done by the exporter after signing the agreement in order to complete the deal, which takes some time, ranges from 1 month to 1 year as per contract. That means there are some time differences arise between the signing date of the contract and settlement date of the deal. Due to this time difference, the exchange rate may fluctuate within this time. Since the exchange rate are very volatile and also they are difficult to forecast owing to some external factors like crude oil price variation, inflow or outflow of foreign investment, and some internal factors like interest rate, inflation rate variation, etc., may activate on exchange rate, causing to affect the both parties, that is importer and exporter, and their cash flow. In short, the transaction exposure arises due to the time difference between signing the contract and settlement of the deal. For example, an Indian company is exporting one machine worth of $1.2 million to USA. The date of signing the contract was 1st January 2023. Late the exchange rate was rupees 78.20 per dollar. After 3 months, that is on 1st April 2023, when it was settled, that is received the payment in dollar, let the exchange rate became rupees 78.50 per dollar. For exporter, they will gain rupees 0.30 per dollar or rupees 3.60 lakh in total. If it is a case of importer, he will lose the same amount on the payment to the exporter of the contract. Due to fluctuation of exchange rate within the time span of signing the contract and date of settlement. Translation exposure. Multinational firms operate in different countries through subsidiaries which tend to operate in the local currency. Therefore, the asset, liabilities, revenues and expenses are measured in local currency rather than the currency used by the parent company. The local currency of the subsidiary company is usually the unit of accounting, operating, financial statement and taxation at the local level. The translation exposure arises from the need of translation or conversion of financial statement such as profit or loss account or balance sheet of the foreign subsidiary company from its local currency to home currency of the parent company for the purpose of reporting the consolidated financial statement of all its subsidiaries to the shareholders or regulator. Assume an USA company has a subsidiary company in India. The financial performance of the subsidiary will be in local currency of INR. Between year 1 and 2, the revenue of the company has grown by 10% and achieved the cost efficiency, that is variable cost increases to only 6%. That is, instead of 10% increase, comes down to 6%. This result in an impressive 26% increase in contribution in the local currency. However, because of impact of exchange rate fluctuation, the financial performance of the subsidiary looks different in the parent company's reporting currency of USD. Over the 2 years period, the dollar has appreciated and USD INR rate increased from 68 to 70. Now, transaction in INR. First year, second year variance. Revenue in first year 10 lakhs and revenue in second year 10% increase, that is 11 lakhs and 10% increase. Variable cost 8 lakh. Now it comes for 8.48 lakhs instead of 8.80 lakhs and 6% increase. Contribution is 2 lakh in the first year, in the second year 2.52 lakhs, and the efficiency on contribution between these two second year is 26%. Now, transaction in USD. First year, $14,705.88. That is rupees 10 lakh divided by 68. And second year, 15,714.29. That is 11 lakhs divided by 70. And increase is 6.86%, that is, instead of 10%, it comes down to 6.86%. Now, variable cost 11,764.71 and next year 12,114.29. Here it is 2.97%, and contribution is 2,941.17 and second year 3,600, and it comes down to 22.40% from 26%. After converting to dollar, revenue of the subsidiary company is falling to 6.86%, not 3%, instead of 10% in local currency, and the contribution is also dropped to 22.40% from 26%. If the base currency USD depreciate, then the revenue and net profit will also increase. Difference between transaction exposure and translation exposure. Transaction exposure impacts the cash flow movement and arises at the time of cross-border trade, that is, purchase or sale in different currencies. Translation exposure arises due to conversion of financial result from one currency to another currency. In transaction exposure, there is no need of parent company having a foreign affiliate or subsidiary company, but only business transaction between two countries is required. Translation exposure risk is incurred by companies having business operation in multiple countries and conduct transaction in different currencies. Transaction exposure result in realized gains or losses. Translation exposure result in notional or book gain or losses. Economic exposure. Economic exposure arises at the time when a company of one country, say USA, set up a manufacturing unit in other countries, say China, with an object to take an advantage of lower manufacturing cost and then ship the products back to USA. Now, if the Chinese currency, Chinese yuan, is strengthening significantly, then many of the predicted cost benefit will be wiped out, which can greatly affect the company's competitive position. For example, say goods worth CNY 1 lakh was dispatched in the year 2021 and 2022, where USD CNY was 7.14 in 2021 and 6.52 in 2022. Then after converting goods value into the dollar, it will become $14,005.60 in 2021 and $15,337.42, which will reduce profit element of the company in the second year when the Chinese currency appreciated, where USD company does not have a good balance of inflows and revenues denominated in the home currency, since the manufacturing cost has been increased in terms of dollar. When US dollar increases sharply against all other currencies, US exporter sales will be adversely affected. For this, profit of the company will be impacted because of a stronger dollar, means less revenue coming from abroad to fuel the profit of US export companies as the commodity prices denominated by dollar becomes more expensive and many countries cannot afford it. In general, importing and exporting firms face a higher degree of economic exposure than purely domestic firms do. Importer will be benefited when domestic currency becomes strong and exporter will be benefited when domestic currency become weak. Economic exposure measures how changes in foreign exchange rate affect cash flows of the firm. Economic exposure is obviously greater for multinational companies that have numerous subsidiaries overseas and a huge number of transactions involving in foreign currencies. Since unanticipated rate changes affect a company's cash flows, economic exposure can result in serious negative consequences for the company's operations and profitability. Let a US company XYZ has a 10% stake in a fast growing European company PQR having market cap 900 million euro, valuing 10% stake of XYZ is 90 million euro. The company is concerned about potential decline in the euro and would like to estimate its economic exposure. Now the exchange rate euro USD is 1.25, then the value of the investment will be $112.5 million. If the exchange rate decline to 1.10, the value of investment will be $99 million. Thus, the economic exposure arises due to effect of unexpected and unavoidable currency fluctuation has an adverse effect on company's cash flow and market value, and it is a long term in nature. Economic exposure is the most relevant exposure from the long run perspective of a firm. Now come derivative. Derivative are financial instrument the price of which is directly dependent on or derived from the value of one or more underlying securities such as currency, stock market indices, rate of interest, commodity, etc. It is a contract between a buyer and a seller regarding a transaction or to be settled on a predetermined date in the future. Derivatives provide risk protection for hedgers who are exposed to a risk, like exporter or importer, by transferring it to the speculator or trader who are with high risk appetite. Since financial markets are very risky because these markets are extremely volatile, prices of securities like currencies, equity, commodity and interest rate are changing constantly, going up and down, affected by various external and internal factors. Due to risk element in financial markets, derivatives are used by the investor to protect inherent risks in financial market as much as possible. Derivatives are traded on an exchange platform or bilaterally between counterparties. The latter is known as over-the-counter OTC market. I have already given idea on OTC. Now I explain it. OTC derivatives are created by an agreement between two specific counterparties. Exchange traded derivatives, on the other hand, are fully standardized and their contract terms are specified by the derivative exchanges. Over a period of time, based on the need of market participants, various derivative products have evolved in OTC and exchange traded derivative market, such as forward derivative, future derivative, option derivative, swap derivative, and interest rate derivative. Over the last 3 decades, the derivative market has been seen a phenomenal growth. A large variety of derivative contracts have been launched at exchanges across the world. Some of the factors driving the growth of financial derivatives are: number 1, the asset prices in financial market become uncertain owing to increased volatility that makes the transaction very risky, which is reduced by the investors by applying the derivative techniques. Number 2, there is a seamless integration between national financial market and international financial market, for which the derivative market becomes much more effective. Number 3, there is a marked improvement in communication facility and sharp decrease in their cost, for which the derivative market remains most active. Number 4, due to the ongoing development of more sophisticated risk management tools that provides a wider choice of risk management strategies of an investor through derivatives. Innovation in the derivative markets, which optically combine the risks and returns over a large number of financial assets, leading to higher returns, reduced risks, and lower transaction costs as compared to individual financial assets. OTC, an over-the-counter derivative, is a financial contract that is arranged between two counterparties, that is buyer and seller. The negotiating bidding process is matched through a network of telephone or electronic media that link thousands of intermediaries like banks, foreign exchange dealers, and brokers with minimum regulation. OTC derivatives do not have standardized terms, and they are not listed on an exchange. That is, the transaction occur in private qualified counterparties who are supposed to be capable enough to take care of themselves. What is underlying asset or security? Underlying asset are the real financial asset upon which the derivative is based. The underlying asset is independent and derivative is dependent on and derived the price on the underlying asset. The derivative cannot exist without underlining. They do not have a value of their own. Derivatives are usually traded by predicting the underlying asset's future price movement. The price of the derivative is determined by the price of the underlying and not the demand supply for derivative. The underlying is raw material and derivative is finished product. If the underlying price goes up or down, the derivative price will go up or down regardless of demand or supply of derivative. Underlying price or current market price CMP or spot price is a fundamental component for calculating a price of derivative. Types of underlying asset. Number 1, stock. Number 2, stock market indices. Number 3, bond. Number 4, currencies. Number 5, commodities. Now first come stock. In the capital market, one of the most widely used underlying asset is stock or shares of the company, which get influenced by the host of factors like overall market risks, fundamentals of the company, and general economic situation, etc. The market forces demand and supply are the primary determinant of the prices of such underlying asset. Exchanges have laid down criteria for stocks to be used as underlying asset in future and option F and O trading. Stock market index. A stock market index is the statistical measure of the performance of the market, the economy in general, or in particular areas, reflecting the ups and downs in it. And indices play a crucial role in defining the flow of stocks in a certain direction, and thus they are considered as the barometer of the stock market. In case of financial markets, an index is a portfolio of securities that represent a particular market or a portion of a market. The index is usually expressed in terms of change from the value of the base year. The percentage change is more important than the actual numeric value. The financial indices are created to measure the price movement of stocks, bonds, T-bills, treasury bills, and other types of financial securities. It is an underlining for financial application of derivatives. Various products in OTC and exchange traded markets are based on indices as underlying asset. Now, bond and other debt instrument. Bond of different types and other debt securities that attract interest rate are also used as underlying assets in derivative as interest rate future. Interest rate derivatives IRD is a financial derivative contract whose value is derived from one or more interest rate, prices of interest rate instrument, and interest rate indices. Interest rate derivative, I will explain it later when come to bond. Commodity, that is, derivatives have become an integral part of today's commodity trading and are used for risk protection and in innovative investment strategies. Since commodities are frequently used as input in the production of goods and services, uncertainty and volatility in commodity prices makes the environment erratic, unpredictable, and subject to unforeseeable risks. Derivative trading facilitates the integration of national commodity markets with the international market. There are two types of commodities. There are two main types of commodities that trade in the spot and derivative market. One is soft commodities. These are perishable agriculture products such as corn, wheat, coffee, cocoa, sugar, soybean, etc. Next is hard commodities. These are natural resources that are mined or processed such as crude oil, gold, silver, copper, etc. Currency. A currency is considered as underlying asset in derivative contract between a buyer and a seller to exchange fixed quantity of currency on a pre-decided date and rate in the future. Currency derivatives are mostly used by importers and exporters or by any allied active parties involved in foreign currency transaction to protect themselves from any risks arising due to appreciation or depreciation of exchange rate. Today I stop here. Next day I will discuss derivative. Thank you.